Welcome back, investors, to Ticker Time News. I'm Adam, and this holiday shortened week started on a volatile note for the stock market. Major indices opened somewhat higher with a gap up, ever so small, but it quickly headed to session lows, logging those session lows early on, right about here on the chart. This is the 5-minute chart of the S&P 500, ticker symbol SPX. Now, the S&P 500, it tested a very important level, 3,900. It did it last week too. And today, the level 3,900 just kind of barely, it's this line right here, okay? It runs through here and boom, right here again. This morning, it dipped down below that 3,900 level. And yes, the markets are looking pretty darn weak, but they are looking pretty darn oversold too. So we're getting kind of two technical flashlights here going beep, beep, beep. We've got a little problem. Things aren't lining up pretty well. So I want to kind of point those two combating theories that are happening right now in the market out in this live stream, starting here with the S&P 500. Look at this. The 3,900 level are the three upper dashes, obviously. This bottom dash this morning, it broke that 3,900 level, but it quickly returned. We get above it later in the day, and we can't break above that blue trend line that you see going on a top there. But I'll show you that when we go to the daily view. And then we come back down. We barely break down underneath the 3,900 level down here. And then into the close, we bounce off of 3,900. And that would be 3,900 would be 390 on the SPY. This is a very critical level. And if I scroll back and show you last week's lows were down here too, around the 3,900 level. If I go back even further here, well, I might want to change this. Let's do this. 5-minute chart doesn't work very well for going back in history to look at several days, but let's let the chart load here. And this 3,900 level is very, very important, extremely important. The markets have been bouncing around those levels for the past couple of sessions, and here we are doing it today. So it's important, right? Okay, let's clean this chart up here just a little bit, and then we'll get moving on. Just remember, 3,900 on SPX for the S&P 500, and 390 for the SPY. Those are your two key levels that you want to continue to watch. If we get momentum, so high volume at 3,900 or at 390 on the SPY, if we get high volume, then we could likely see a bounce from this level. And the longer the S&P holds this 3,900 level, the more likely that bounce becomes. In my book, that's what I'm thinking. However, to be the complete opposite of this, if the 3,900 level does not hold and we break down to 37, 38 even, kind of keeping it up there. If we get to those levels, then I think a breakdown and we're headed for bigger risk and lower lows if that occurs. Now, this week, sure, there's a little bit of economic news, there's some Fed speak, but the big news is next week on the 13th. That's our next read on inflation. So if the market can hold 3,900, then I think the market could slowly creep higher for the rest of this week, potentially then moving sideways at the beginning of next week into the CPI report in our next read on inflation. If that could take place, that's a likely scenario. But again, a breakdown below the 3,900 level down to 38, 37, and then I think we're just going to, continue to go downward and build more risk as we move down in front of that inflation report. Because what if CPI ends up ticking up even, 0.1%? that's in the wrong direction, and I think the markets would not like that at all. Plus, we have got an energy crisis in Europe that could very well affect us, and it's definitely playing a role on oil and energy, which I'll talk about in a little bit. Okay, so we talked about the markets today. They were in positive territory for a very brief time, but they're all down. Let's see. The SPY down 0.4%. The Qs down 0.7%. The IWM down a full percent. So that's what we had for today. Now, the S&P 500. It closed, as you can see, bottom right of the screen, 3908, just above that key technical level of 3900. Now, selling pressure today, it was fueled by rising treasury yields. They played a big role today. While buying interest, it was driven by positive sentiment and the S&P 500 finding support at 3,900 and being oversold. So let me go to the daily chart here. We basically got two factions. I don't even know if I want to call it bulls and bears anymore. I think I just want to call it, momentum. And which side is momentum on? Is momentum on the side that's going to take us higher, or is momentum on the side taking us lower? Now, here is the SPX, right? RSI is in the gutter, 37.5. That is oversold, okay? Right now, we've got the MACD. It's barely starting to curl. So maybe we could have a few more red days before it finally does curl over. But it is starting to, but ever so slightly. And look at this. We had this head and shoulders pattern kind of here break loose, and it's come down. But look at this blue diagonal line right here on your screen. Look at this. Last week, this was support. This week, this line right here is resistance. And we've got the weekly expected move up here too. The bottom end is 38.30. The upper end is 40.18. And I find it significant because the 38.30, there is a gap down here just under that 38.30 level, okay? All gaps get filled. Are we just going to continue to drift off the rest of the week and, fill that gap? It's possible. That's a possibility. And if we get any type of a bounce, again, it's got to break above 3,900. You can see it's at 3908 right now. And then I think the gap right here, that would kind of be our target. And it's not that far away, quite frankly. It's at about 40.50, 40.60 or so, where that gap first kicks in. So I don't think it's going to be a big bounce if we get a bounce, but it looks like we might be due for some sort of a bounce. Now, Treasury yields, they hit highs around mid-morning, and they settled just off their high levels. The 2-year yield breached 3.5%, rising 11 basis points to close the day at 3.51%. US, I know I'm bringing this up 02Y. I know I'm bringing the yields up a little bit earlier than I normally do when walking through this, but they just moved very significantly today. 11 basis points. This thing is running hot. It is above its 5-day EMA. That is bullish. It closed above that. That is bullish. At the end of last week, Thursday, we had that move down in the 2-year. And I was like, okay, well, what is this? Now we're moving back up, and we have this high on September the 1st of 3.55%. I'm kind of thinking that I might have to just move this resistance line up, potentially 3.55%. Can we hold there? Let's change this color. Maybe that's going to be a new area of resistance that I'm hoping we don't break through, quite frankly. All right, 3.51% is where it is right now in the after hours. Now, the 10-year today, let's look at that. US 10Y, and then we'll be done with the yields. The 10-year rose 13 basis points to 3.33%. That's going to do nothing, absolutely no good for the housing market. When the 10-year goes up, so do mortgage rates. And this 13 basis point rise today, I mean, look at the strength. Look at this. It's just been crazy. It's way above its 5-day EMA. I would suspect tomorrow, unless something crazy happens, I would suspect that tomorrow might be a down day over here as it pulls back to that 5-day EMA. Let me just give you a couple of examples. I want to blow this up a little bit bigger than it is to make it easier to see. All right. So over the past few trading sessions, when the 5-day EMA is moving like this, okay? Bear with me here for just a moment. Whenever we get a big run, like this candle right here, when it moves up quickly, the very next day we get a red candle. Same thing occurred right here. We get a big green candle and then a red candle follows it. We got a big green candle today. So is tomorrow going to be followed by a pullback? And a pullback too, where do the pullbacks occur? That red candle drops all the way back to the 5-day EMA. So we closed way above it today. We'll probably tomorrow see a pullback to come closer to that 5-day EMA. And that 5-day EMA right now sits at 3.28%. So if we get a pullback to 3.28%, that should help the equity market, especially the tech sector, to maybe put on some gains tomorrow, okay? So just keep that in mind. Whenever they go up significantly, and it's always the rate of change, the bigger the rate of change, the more harm they'll do to equities and technology. Smaller rate of change, and sometimes both the 10-year and equity market can move together. So keep that in mind. All right, let me just clean this up real quick, and then we'll get moving on. Now, the 10-year and the 2-year rising so much today. This comes ahead of the ECB meeting on Thursday, okay? Now, market participants are watching this closely to see if the central banks raise its key policy rate by 50 basis points or 75 basis points. Why does that matter? Well, let's go over here. Let's see, just real quick. Oh, I always type that thing in. CME. See me. I don't know why I get the letters backwards, but I always do. But it usually knows what I'm searching for, so it doesn't matter if I get the letters backwards. Okay, where right now, for our Fed, where do market participants believe we're headed? September 21. September 21. We will get an update from the Fed on, and look at this. Oh my gosh. An update on the Fed on whether we're going up by 75 basis points or we're going to go up by 50 basis points. Do you honestly think that the market right now has a 75 basis point rate hike baked into the cake? Or do they have a 50 basis point rate hike baked into the cake? I don't know. But right now, here's what market participants think, and I'll show you how this has changed. Right now, for a 50 basis point rate hike, it is the block on the left side of your screen. We are at a 28% for a 50 basis point rate hike. On the right side, the right block, that's a 75 basis point rate hike, and it's sitting about 72% believe we're going to get a 75 basis point rate hike. That's where it stands. Now, let me tell you this. 1 week ago, where were we standing? 1 week ago, we were at, oh, that's not helping me much. All right, get out of here. Let's see here. Okay, yesterday. This is very interesting. September the 2nd. Okay, so that's last week. September the 2nd. We were at a 43% 50 basis point rate hike. We're at a 28% now. We were at a 57% for a 75 basis point rate hike. Now we're at a 72%. So we went from just above 50%, 57% up to 72% for a 75 basis point rate hike. So that's where the market thinks we're going. The market thinks we're going to get a 75 basis point rate hike in. Now, something else that was strong, the US dollar. It rose sharply today, along with market rates, the Treasury. Now, the yen, it fell to a 24-year low against the dollar, while the euro dropped to a 20-year low. And whenever the dollar is strong, equity markets are weak. And we've talked about this for months now, that, hey, this back here on July 14th was not the high for the dollar. And I said, and you can go back and watch the videos, I said that we needed to break above this point, which was 109.29, basically 109.3, for this dollar to keep running. Last week, the dollar consolidated. The week before that, the dollar was consolidating after a strong run up. And this was a bull flag that we had marked out here when talking about the dollar. It was probably a live stream a week ago when we were talking about this. And now the dollar kicks it off, takes off. It is above 110, 110.55 was the high today. And it's at, or it closed at 110.25. So it is in that boom, rocketing phase that we talked about. And when the dollar goes up, equities go down. So equity market had two negative things working against it today. A fast rate of change on the 10-year, on the Treasury, and a fast rate of change on the dollar. The dollar was strong. That put equity markets in a weak stance. Okay? So those were the two big things hitting the markets today. Now, selling today, it was modest but broad-based. The Vanguard Mega Cap Growth ETF, ticker symbol is MGK. We track this one because whenever Mega Cap Growth is moving, that's the direction that the market is moving to. It's been moving down. It's been pulling back. I have the weekly expected moves already on this. You can see today we have just pulled down slightly, 0.5%. The bottom of this is 182.9 for the week. The upper end is 203. Which way do you think we're going to be going? Well, mega caps right now have been putting in lower lows, and it looks really weak right now. But it's also looking a bit to the oversold side. The Vanguard Mega Cap Growth ETF RSI is at a 27.6. I want to point this out. It is oversold. However, to see a real good, strong bounce, we need to see volume kick up. Now, the Invesco S&P 500 Equal Weight ETF, ticker symbol RSP, it was down a little bit more today, or a little bit less. It was down 0.3%. And then you throw in the S&P 500 down 0.4%. So just something to pay attention to here. We have to watch mega cap growth. They are directional, or they have a directional bias on the market. They are oversold at this point. Now, market breadth today, it also reflected the broad nature of today's selling. Decliners led advancers by a greater than 2-to-1 margin at both the New York Stock Exchange and the NASDAQ. Now, the S&P 500 sectors, let me pull those up here for you real quick. Most S&P 500 sectors, they closed in the red. And you can see there's a good mix up here on the right side of your screen of all of the different S&P 500 sectors. You know, we had communication services, which are XLC is the ticker, down 1.3%. Energy, XLE, down 1.1%. Those were the two biggest losers today, and they're at the bottom of the pack. Now, real estate, ticker symbol XLRE, that was actually up 1%, and utilities was up 0.2%. They both sat atop the leaderboard. That's a defensive play. Your utilities, healthcare, defensive play. Now, semiconductors, they sold off sharply. Let's go down here. Ticker symbol SMH for the Van Erik Semiconductor ETF. Now, semiconductor sold off hard and more sharply than the broader market. The Van Erik Semiconductor ETF, it closed down 1.1%. Now, I think I see something potentially happening here. I don't typically talk about trade setups before they happen, a lot of times on the live stream, because I want to save that for our investor community. But I just want to point this out. Semiconductors have been getting hammered, okay? Right now, the RSI for this ETF is 26.9. They've been getting hammered. So I want to point out a potential play here. We're going to go to ticker symbol is SOXL. This is a 3X bullish ETN. It tracks the semiconductor industry, but it moves in the inverse direction. I'm sorry, my apologies, not inverse. I'm so used to using inverse. This moves right along with the semiconductor industry or index or ETF, except it's a leveraged account. It will move 3 times faster. So if the semiconductor ETF goes up by 1%, SOXL will go up by 3%. But the same is true for downside risk. Those who don't want to play options, this is a great way to use leverage without getting into the options market. So I just want to point this out. Ticker symbol again, SOXL. Now, I'm not saying jump in right now. But what I am saying is that it's not too far right now, this move down. It's not too far from a full measured move of its head and shoulders pattern. And that lines up with a previous level of interest. The green bar down here for this ETF, somewhere around $10 to $11. That $1 spread right there. That looks like it could be an interesting place, a very interesting place to potentially ride a bounce from this low. Now, this is the July 5th low. If that low gets taken out, I think that gives us a better chance of a bounce. So I just wanted to pull that out. It's something that I'm watching. It's caught my eye, and I want to give it to you guys so you can watch it too. because if it does bounce, I think it could provide a nice return, at least up to this 50-day moving average, which is sitting about 1687 right now. So this would be a move from about $10 or $11 up to about $15 to $16. So that would be a solid gain right there. Okay, just want to point this out. Now, energy, it settled this volatile session in mixed fashion. WTI crude oil, look at that, US oil in TradingView, and there is a link in the description to TradingView. Also, if you want more trade ideas, click the first link in the description. We do numerous trade ideas 3 to 4 times per week, and when I say numerous, I mean numerous. Today, we even added a new category in our trade setups. Now, here's oil. It is finding its support around $85 a barrel, okay? Now, it rose barely anything today. Barely anything. 0.07%. It almost got and broke above the $87 a barrel, but not quite. So it's holding at support right now, okay? It's holding at support. This is a very interesting area at $85 a barrel. Now, natural gas today, boy, that thing fell like a rock, down 6.4% to $8.19 per British thermal unit. Now, this comes after Russia indicated that the shutdown of the Nord Stream 1 pipeline is going to last long time. It's going to be long lasting. Quote that, quote, long lasting. And that's a quote that came from the Wall Street Journal. Plus, we have OPEC. They announced that they're going to cut 100,000 barrels in production. Not a whole lot in the grand scheme of things, but it is enough to say, hey, whoa, why are you cutting that production? This will be a tough winter for Europe. There'll be an energy crisis, and that can spill over to the U.S. as well. All right, digging into today's economic data. We got the ISM non-manufacturing index for August. It increased to 56.9%. Expectation was 55.2%. The dividing line between expansion and contraction is 50%. The August reading marks the 27th straight month for growth for the services sector. The key takeaway is that business activity for the non-manufacturing sector accelerated slightly in August. At the same time, there was a deceleration in the pace of price increases. The acceleration in overall activity, however, fits the notion that the Federal Reserve will continue to raise its policy rates and will not be quick to pivot to a rate cut cycle. I know. I say it again and again. There will be no rate cuts. There will be no Fed pivot in 2022. All right, looking ahead to Wednesday, market participants will receive the weekly MBA mortgage application index. The prior reading was negative 3.7. That comes out at 7 a.m. Eastern. Then the July trade balance, the expectation is a loss of $70.2 billion. The prior reading was a loss of $79.6 billion. That's at 8:30 a.m. Eastern. And then we get the Fed's beige book. That comes out at 2 p.m. Eastern. That could have a little sway on how the markets react tomorrow. But that's not until 2 o'clock Eastern, not until the afternoon. So we've got all morning for the stock market to do what it would like to before we get that information. Okay? And again, with the economic data coming out tomorrow, that's probably the most interesting one, because we can see, we can read what the Fed is thinking, and that will give us a better indication of where the Fed thinks it's going. Okay? So make sure we'll talk about that during tomorrow's live stream. Okay, that is everything I wanted to touch today. We got through it quick. Do me a favor, please, and click that like button. Share this video with a friend. And if you want more of this perspective, if you want to trade setups, if you want our weekly expected moves on 40 different products and a whole bunch of market analysis, click the first link in the description or join our Discord, tickertimenews.com/Discord. We've got public and private channels there for everyone to learn from. All right. Thank you, my friends, for joining me today. I greatly appreciate it. It was a quick day. Not a lot really happening in the market, except I feel like this rubber band keeps getting pulled back harder and harder and harder. How far can it go before it snaps, sending us into a short-term bounce? Dead cat bounce? I don't know how far it will go. Probably not very far at all, because we have got other news like CPI on the 13th and rate hike decision on the 21st of September. Those two things will be big movers in this market. And if the market gets pulled back too tightly on that rubber band, then if we do get a reduction in inflation, that could be the catalyst to snap the rubber band, allowing for a short-term bounce in the market, because the market is oversold. But one thing to point out is that markets that are oversold, they can stay oversold for a while, and they can also go deeper in the hole, and they can become even more oversold. I mean, a 27.5, that's not even the lowest it's been this year. If we look at the low of the year so far on June, well, technically it would be June 17th. That was the close low of the year. What was the RSI? 27.4. And the 16th was 27 for the RSI. And we're currently at a 27.5. So relative strength basis, we're at the low, but it can fluctuate, right? Okay. Yep. I waited. I saw that comment wait. So I'm holding up. Okay, why is natural gas down if it's going to be in higher demand? Okay, let's do this. Why is natural gas down if it's going to be in higher demand? Okay. There's a couple of ways to answer this question. One is what's happening in Europe, what's happening in China, and what's happening in the United States. Okay. Let's pick China for just a quick example. When China locks down, demand goes down. When demand goes down, obviously, supply needs to match that, and supply needs to come down too. That's one part of this multifaceted beast, this global economy that we have. So China locked down millions and millions, tens of millions. I think it's 21 million residents just last week. That will cause demand to go down. If we look at Europe, for Europe will have the demand. Europe is open for business. But the problem is, if food prices are really, really high, then nobody has leftover income to go driving around, to take a trip. So the supply, demand falls, therefore supply must too. So that's inflation in Europe and lockdowns in China. Now here in the United States, well, we don't have it too bad, I guess, in relative sense. Yes, we have inflation. Yes, inflation came down on some things, but inflation did not come down on food. And food takes petroleum. It takes natural gas. Greenhouses, they need the natural gas in order to stay warm during fall and spring, even during winter. So right now, we're in a unique situation. Plus, on top of that, August and September are usually two of the worst months for oil, for natural gas. So we're only halfway through this August and a little more than halfway through this August and September slump. Okay. Kids go back to school. People go back to works. They're done with their vacations. It's a slump. But then after September, then oil, natural gas, they all start to pick up. Okay. Demand starts to increase. And if China doesn't do lockdowns, that will help demand to rise. If Nord Stream 1 is continuing to, stay shut down once we get into October, November, December, when temperatures continue to rise, going down. When temperatures continue to go down, it's getting colder and colder and colder. Demand will slowly tick up, tick up, tick up. So just with those two, China and Europe, they can heavily affect even the price of natural gas here in the good old USA. So the simplified answer to the question of why natural gas is down, if demand is going to be higher, it's in the going to be. August, September have a slump in petroleum product usage. Okay. We need to wait till October, and October should give us more of a direction on where these energy prices are going. Now, I personally think that these energy prices will go up. And the reason for that, I think, may be on the supply side. However, if the supply side goes down, and if the supply side is artificially under pressure, that will cause prices to go really high, especially in Europe. And Europe is going to be one place that gets it worse than anybody else when it comes to energy prices. Unfortunately, that's going to leave many out in the cold because they just won't be able to afford energy. If you can't afford energy, what's that going to do to demand? Yeah, you have demand because everyone wants to stay warm. But then again, what if? And this is something that's plaguing the price of energy. What if energy prices go so high this winter that nobody can afford it? Then demand will drop, and that'll cause prices to drop. So right now, there's not a lot of data on where we're going to go from here. Oil, natural gas, down slightly. I mean, U.S. oil is not really down slightly. Let me pull that up real quick. Natural gas being down today mainly had to do with the Saudis, OPEC, lowering what they are going to put into the market, right? Lowering the supply to try to cause demand to go up. So I think from now until the end of October, we could see energy prices continue to go down. But it's that October, November, going into December even time frame that we have to watch what's happening in the geopolitical space, because that's going to let us know how the markets are going to react and how prices are going to react this winter. So I guess what I should have said up front is this thought that I'm having now with the geopolitics of it all. It's a complicated question. And all I can say is right now we're seeing a slump in prices, and that will probably continue through September, okay? But then we get to October and November. What's the situation? What is Russia doing at that moment? What is China still doing? If in the fall, I mean, the U.S. just announced that they want us to get the COVID vaccine yearly, just like we do with the flu vaccine. Well, what if China has to shut down over this winter? Is that going to affect the supply side of things? The demand side of things? I think it's an open question. So I know I didn't answer your question in greater detail. But right now, historically, this is a downtime for energy prices through the end of September. I'll do more research on this, and I'll see what answers I can come up with geopolitically. Maybe, back when Russia was playing around with energy prices when it annexed Crimea, maybe that can give us a slight insight into what we could expect this fall and this winter. All right. Okay. I guess that's what I wanted to say there to go with your question right there. I do think demand will be high, but there's a couple of different things that could come in play this winter, and the price of it all, I think, will play into that. I also want to look back in history, and I want to see how many times have we gone into a seasonality of demand, but yet inflation was so high that the cost for natural gas and for oil were also so high that people could not afford the oil to stay warm. What did that do to supply and demand, and of course the price at that moment in time, at that point in history? So I'll look back and see if I can't find I know there definitely is some similarities, but what happens if price rises so high that you can't pay for it? Will that affect supply or demand or both? So I'll look into that some more and see what I can come up with. Okay. Outside of that, tomorrow I think is going to be another wild day. I really believe we're pulling the rubber band back on a potential short-term bounce in the market. But that 3,900, and I'll pull up SPY here real quick, and then we'll sign off. That 3,900 level on the S&P 500 and the 390 level on the SPY, it is critical. It is important. And just one more thing to point out here on the SPY, that 390 level, okay? If I go back here to July the 26th, this was the last, like we had a rally and then a pullback. That price point right here at 390, that was what set us off to the finish this rally. That was like all right, let's go. We've got it. Let's go. We're going to rally now. That was the go point. So this is a very critical moment and a very critical level on whether or not we're going to get a short-term bounce, maybe to cover the first gap, or if we're going to head lower and cover that gap, right? Where are we going? Are we going to, fill this gap down here? Or are we going to get some kind of a bounce to fill that gap right there, right? I mean, I know it can't be any more perfect than either or with this current setup right here, but it is looking, I know, overly bearish. But again, that 3,900 level is holding up, 390 on the SPY. Watch it. Let that help you make your decision on whether you're going to take a short-term long position or whether you're going to go short for the next gap. One of these two gaps are going to get filled, and it's either the one right above us or the one right below us. Oh, boy. All right. Thank you, ladies and gentlemen, for joining me tonight. I'll be back here tomorrow after the markets have closed. We can talk about what happened, why it happened, and what to look forward to over the next day. So I appreciate each and every one of you for spending your time with me. I greatly appreciate it. Click the like button, share this video, and click the first link in the description. Join our new Discord page. Leave some comments on there. Talk and I'll talk back, and we'll all learn something. Okay? All right, ladies and gentlemen, thank you so very much for joining me, and I'll see you in the next video.